After days of relentless buying and historic highs, gold and silver reversed violently the instant Donald Trump signaled his preferred choice for the next Federal Reserve chair. The reaction was immediate and unforgiving. What had been treated as protection against institutional breakdown suddenly became a crowded trade looking for an exit. According to Robert Kientz, this was not a collapse in confidence in metals themselves, but a sudden repricing of political risk that had been driving prices vertically higher. The scale of the move stunned markets. Gold, which had surged to unprecedented levels only a day earlier, suffered a sharp intraday plunge, while silver experienced an even more severe liquidation, erasing a large portion of its recent gains in hours. The reversal was striking precisely because nothing broke in the physical market. Supply constraints, sovereign debt stress, and industrial demand did not disappear. What changed was perception. Trump's signal was interpreted as reducing the odds of a Federal Reserve fully subordinated to political pressure, and that single shift was enough to trigger mass profit-taking. Robert Kientz explains that the sell-off was accelerated by structure, not fear. Speculative positioning had become extreme after a near-vertical rally. Once prices turned, algorithmic selling, leverage unwinds, and stop-loss triggers compounded the decline. What looked chaotic was largely mechanical. Markets that rise too far, too fast do not need bad news. They only need an excuse. Trump's announcement provided it. Yet this episode may prove more revealing than damaging. The speed of the reversal exposed how fragile confidence has become across financial markets. Gold and silver are now reacting not just to fundamentals, but to political signaling at the highest level. That is not a sign of stability. It is a warning. As Robert Kientz points out, when prices can swing this violently on a single announcement, volatility itself becomes the new baseline. The correction, then, is not the end of the story. It is the confirmation of a new phase. Markets are no longer debating whether risk exists. They are responding to how quickly narratives can flip. In that environment, sharp drawdowns and sudden surges are not anomalies. They are the price of a system under strain. Before we jump in, if you appreciate these deep dive market breakdowns, please take a moment to like the video and subscribe. It helps this analysis reach more people while it still matters. I'd love to hear from you in the comments.
The Trump administration said sometime late summer they were committing $4 billion to silver. Some of that was buying silver, some of it was infrastructure. If you look at the mining glut that we have now, refining glut, the refiners in the U.S. are basically maxed out on producing silver, and they're refusing business to reprocess scrap silver and doré bars from mines and things, which is not great because we need as much silver as we can get given the mine output shortage. That a lot of that refinement's going to have to go around the world. So you're going to see some silver move around the world to get refined, and refining costs are probably going to go up a fair amount. So there are going to be issues with fulfilling silver orders. And I think that's why it's become a strategic mineral. I think the U.S. government probably waited 10 years too long to declare that, because it takes about 7 to 10 years to get all that infrastructure permitted, built, and in place. So I think the U.S. government is somewhat chasing the silver market right now. And so I think that's, again, what's going to set, some sort of floor on the silver price moving forward and put a lot of upside pressure. Gold, to a lesser extent, yeah, the central banks will continue to buy more gold as we go deeper into economic issues around the world and fiat currency problems. But I almost think if we do have a new Fed chair come in and we do have a repositioning where we go back more into quantitative easing, you're going to see a temporary boost in the value of the dollar. You're going to see a temporary boost in GDP output. Of course, that will cause more inflation long term, and it may be the final nail in the coffin of this fiat currencies, which will eventually lead to a panic and then back into gold and silver. So tying all this together to an earlier question, I think that the gold and silver markets are going to be more volatile going forward for all the reasons we just talked about. Demand, mining output, refining capacity, massive money printing, not only in the dollar, but in all worldwide currencies, and the oncoming issues with sovereign debt across the world. There's going to be a lot of interest in gold and silver, and I think the volatility in prices is going to continue. And I don't think this will even maybe be the worst day in gold and silver that we see going forward. We may see more of these days or in the same vein of, double-digit price drops, maybe even 20-25%. It wouldn't surprise me. If you're long-term stacking, I don't think the fundamental reasons why you do that have really changed. And, that's what I tell people is don't worry too much about the price movements. People got mad when silver was stuck in the low to mid 20s for seemingly years after the potential silver squeeze in early 2021. And then look at what's happened to it now. So patient investors who have done their research ahead of time and have a bit of time horizon to invest will generally do really well in the precious metals. I mean, gold from 2000 to 2020, mid 2024, followed CPI inflation pretty closely, not day by day, but overall on an average, if you look at a chart. In mid 2024, right, sort of beginning to middle of the summer, gold separated from the dollar, it separated from inflation, it separated from other commodities. And I think, Elijah, what we're seeing in gold is it's beginning to become, if we look at Basel III and central bank buying, it's becoming the currency of choice. And I think other commodities and the dollar are now considered to be priced in gold. Gold has sort of reclaimed its title as king of the heap in terms of monetary asset. That's very clear, both in official stance by central banks, their purchasing, and now evaluations. Silver is kind of splitting off and saying, I'm so important to the world that as a commodity that I could reach potentially any price, because when you have so much demand for silver to run the world, to run electronics, EVs, solar, military, medical, it's used everywhere. And you have such a concentrated time, 5, 6, 7 years where we haven't mined enough, and getting new primary silver mines on, there aren't a ton in the world. It's a byproduct. So silver price is very sensitive to being a byproduct of other mines and other factors which have nothing to do with silver specifically. I think silver is going to be much more volatile, but much more promising in the long term in terms of value. So if you can stand the price fluctuations on the market, I think you're going to do okay in either one. I invest in both for different reasons, and I think they're splitting. Silver's becoming more volatile, industrial driven. Gold is becoming more the world reserve currencies. We get into financial issues, and to a lesser extent, silver's taking some of that monetary demand as well. But right now, I think it's mostly industrial issues which are driving, silver's price. The problems we've been talking about. I mean, we're closer to the fiat currencies blowing up. We're closer to debt collapses when you look at history. Even though we'll have GDP surprise for Q4 2025, they're having to ease for a reason. I mean, anytime you get anywhere between 4 and 7% interest rates on sovereign debt like we have right now on the 10-year treasury, which is really the benchmark for most people. You can talk 20 and 30, but 10 years is the benchmark. Then you start having a problem paying for those carrying costs of that debt out of tax receipts. And we're seeing taxes being introduced at the local and state level all over the place, and are they going to increase federally? That's what you're going to start looking for going forward. And with the, if you look at real unemployment, I think it's somewhere around 20-25%. When you look at labor force participation, who wants to work, that never recovered post, the 2008, 2009, 10, 11 Great Recession. So all of the monetary and fiscal moves made by the U.S. government and the governments around the world haven't fixed the issues. So I've come on your program and talked about this for years, and I've been writing and talking about this now for 17 years. I don't fundamentally see any change to the positive in terms of economics. So despite what happens on the goofy derivative markets with gold and silver, those are all short-term things. The long term is still bullish up on gold and silver. For all of those reasons. And like I said, if you can stand the oncoming volatility, but what will be interesting is there will be a point at which gold and silver are more priced for their physical supply and demand. They're not right now. People made the mistake over the last couple of months of saying that they thought the Shanghai market and other factors had released gold and silver to be valued per their global supply and demand, physical supply and demand. Friday was a reminder that the derivative markets still rule the roost on pricing. And, the derivative markets are a little goofy, but we'll eventually get to the point when we get into deeper fiscal problems and deeper industrial shortages of silver where that matters less. And I think the last 2 years were an indication of the future. The last 2 years were gold and silver repriced more closer to where they should be. I don't think they're done with that yet. And because fundamentals haven't changed economically, and with the fundamentals of supply and demand, the metals, I think we're going to have another, big boom, in my opinion. But you'll have volatility along the way. And, until the debt problems, the fiscal problems around the world are resolved, and until geopolitical concerns reduce, in other words, until the risk environment comes back to what you would see more normal on a worldwide basis, I don't think you'll stop seeing elevated gold and silver prices.
In the immediate aftermath of the dramatic sell-off, it became clear that the metals were reacting less to fundamentals and more to positioning and market structure. According to Robert Kientz, the extreme moves were driven by near-vertical rallies that left the market primed for mechanical selling. Once the trigger came, in this case, Trump signaling his preferred Fed chair, algorithmic trading, leverage unwinds, and stop-loss orders accelerated the decline. What looked like panic was largely a function of how the system operates under stress, not a reflection of diminished confidence in gold or silver themselves. Kientz emphasizes that physical supply remained unchanged. Mining output, industrial demand, and bullion inventories were not the cause of the drop. It was the unwinding of paper positions that dominated pricing. The sell-off highlighted just how fragile confidence has become when speculative flows and political signals intersect. The market's reaction to Trump's announcement revealed that volatility has become the baseline. A single policy cue is now enough to trigger cascades in prices that can dwarf any underlying fundamental change. Looking ahead, Kientz sees this not as a setback, but as a reset. Silver, in particular, remains in a structurally tight position, with industrial demand rising and free-floating inventories gradually declining. Volatility will persist as derivative positions adjust and new narratives form, but for those focused on the long term, the metal's underlying value is intact. In this environment, sharp swings are to be expected, and understanding the mechanics behind them, from political shifts to algorithmic flows, is now essential for anyone seeking to navigate the metals markets effectively.
Gold is, well, it doesn't have one. There's one in silver. I don't see one for gold or micro gold. If I look at both silver and micro silver, it's 10%, and E-mini silver, and on the futures only, not on the options. You also have it on copper futures. You have it on aluminum futures. Oh, you do have it on gold futures, and it's all 10%. So pretty much across the board on metals, 10% on the major traded items. Why that wasn't triggered in silver, I don't know. I think gold came under that. It wasn't 10%. Silver, I think it was. So that's the question. And then what caused it? We were talking before the show what caused it. The only news item that people are quoting and saying could have caused that cascade of sells, maybe it's a human that started it and maybe it was a computer, we don't know, was that Trump has nominated Warsh as the next Fed chairman, and that the Department of Justice is doing an investigation into Powell. And so somebody's trying to block that nomination for now until the investigation of Powell is done. And that's a little bit of news, but it's not like it's actually occurred. They haven't confirmed a new chairman. The chairman hasn't come on and stated that he's taking any given direction. Also, at the most recent Fed meeting, they're holding interest rates steady. There's expected to be some interest rate drops later in the year, not now. And the Fed has stated that given the information they're looking at, that they're not wanting to make a change in the immediate future. They want to see how employment and inflation goes, specifically employment. Now, if you look at ADP's employment numbers for this week, there was only 22,000 new jobs created. We'll get the big report, the government non-farm payroll, or what they're now calling just the jobs report later on Friday. It typically comes out Friday. But as long as positive jobs are created, then I don't see a reason why that would have caused, and it's only 50,000, that would not cause gold to move either way, really, unless it's a major surprise. And further, if we look further into economic with the United States, last week I was looking at FactSet in terms of Q4 earnings for U.S. corporations, and with only 13% of companies reporting of the S&P 500, 70% of those 13% of companies, so roughly 9 to 10, had a bit reporting earnings surprises, and from what they thought that they would have. Those were led by the Magnificent Seven, which had about 21% earnings of the S&P 500. The other 493 companies were averaging about 4%, but we still have a lot of data to come out from Q4. But it looks as though we're going to have a positive GDP print, unless the rest of the market just is totally tanked, which we're not expecting. So positive GDP print, modest jobs numbers, not a big, surprise on jobs numbers, not a big crash on jobs numbers. The 10-year bond is still elevated above 4% last time I checked, the Treasury. So I'm and the DXY had made a slight upward move, but it's not anything to write home about. It had reversed its fall slightly, a little bit of positive movement from the dollar in the DXY index. So, I'm looking at this going, there was mixed data, and could that have caused somebody to want to go short gold or silver a bit? Sure. But would that explain the biggest price, the dollar amount fall in silver in U.S. history since, 1974 and the Commodities Act and the way that we trade silver now, not as money, but as a commodity, as an asset? No. Should it have caused, almost a $700 free fall price in gold? No. Gold was a tad less surprising because it was under 10%, and we had a massive run up in gold for 2 years. So that I could just explain by saying maybe, somebody big came in and dumped a bunch of gold futures on the market. But in reality, to see that happen to silver at 31% was, to me, it's not explainable in a one-day drop. And when you look at the volumes of paper that were traded, it really looks as though there was some short covering on the futures that needed to happen. And if you look at when options expiration was at the same time on the COMEX, it was the 27th, just a few days before. So what I'm assuming was once the upside, the long options, had been met and expired, that offered an opportunity to reset the board on the price via the futures. Okay. And so I think that there were short covering. Now, if you look at the banker participation report, the most recent one from the CFTC on who trades the gold and silver options, U.S. banks are net short on gold. U.S. banks are net long by about 1,000 contracts on silver. The bullion banks are actually short on silver now, or the global banks. So you can say, maybe it was the global banks mostly that had this short positioning that needed to short cover. And they probably did, because silver had run up so far from the low 20s to about $121 in the span of less than 2 years, really about a year to year and a half in that time frame, that it is quite possible somebody needed, to get out of those short positions. There's some short covering needed to occur. And so I think it more had to do not with supply and demand, not because we had found a bunch of more silver, not because of a Fed announcement or GDP or labor or economic reasons. It simply was the fact that whoever was in short silver didn't want to be short silver any longer. And there was a slide in the silver price and in the gold price to cover shorts right after options expiration. And I would even go far if I'm stepping out on a branch and pure speculation. If you look at the timing of this, we had that massive run up, those options had expired. Maybe somebody made their money on options and decided to short it and bring it back down and make money on the other side in shorts. It looks to me more like financial engineering makes more sense. And the fact that the circuit breaker wasn't tripped 10% in a day, there's questions for CME Group and the CFTC, the regulator, as to why that occurred and why that 10%, based on the table I'm looking at, it's very basic 10% per day. It doesn't give any other explanation as to, was that 10% per day per trader or other provisions that needed to be met. So I think I think that the CME Group has some explaining to do, and that the CFTC needs to be the one asking those questions.
With markets still reeling from the sudden correction, the focus quickly shifted to how governments and institutions would respond. With the metals having retraced sharply, state-backed buying programs and strategic reserves quietly absorbed a portion of the oversold positions. These moves, often subtle and behind the scenes, helped stabilize prices, signaling that gold, silver, platinum, and palladium remain strategic assets rather than speculative instruments. Their intervention created a temporary anchor in a market still sensitive to political and economic signals. Pricing dynamics now reflect a more cautious market environment. Paper positions continue to dominate intraday swings, but physical demand has strengthened. Industrial usage, particularly for silver and platinum, combined with steady interest from bullion buyers, has created structural tension. Analysts expect metals to consolidate in the near term, with volatility spikes tied to any geopolitical or policy news. This sets the stage for disciplined accumulation by both private investors and institutional holders, gradually reinforcing the market's underlying fundamentals. Looking ahead, the outlook points to a bifurcated trajectory. Derivative-driven volatility will continue to produce dramatic intraday swings, while strategic and physical buying slowly drains liquid inventories, particularly for silver. Over the next 12 to 24 months, metals are poised to trend higher, with silver likely outperforming gold as scarcity meets industrial demand. Sharp corrections may occur along the way, but the broader path suggests stronger pricing and tighter availability. The pressing question remains, as volatility persists and demand pressures mount, how far can the metals climb before supply constraints become a defining factor? Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.